Hi, my name is Christopher Lester, Chartered Financial Consultant, which is like a CPA in financial planning. I'm also a retirement income certified planner, as well as a certified college planner. Here in Somerset, New Jersey, and with almost 30 years of experience, I've had quite a few people come through our doors that had questions about life insurance. It's an often misunderstood and confusing topic. So I'd like to take us on a 10-minute conversation so that I can help you to better understand how life insurance works, how it should be properly structured, and what it can do for you and your family to make sure that you maintain your circle of wealth. Chris Lester here, and thank you for joining me here for a quick 10-minute lesson on life insurance. You see at the bottom of the screen the word minimum, and then you see this death benefit. For this example, would be 500,000. What most people don't realize is they quite often know that they're trying to pay the least amount of insurance premiums. What they don't realize is that quite often there's the ability to put a maximum amount of cash into a life insurance contract. Well, why would you want to do that? Well, stay tuned. So the question I normally will ask folks is, who sets the premium, the minimum amount that can go into an insurance contract? And most people get this answer right. It's the insurance company. But here's the trick question. Who determines the amount of money, the maximum amount of money you can put into a life insurance contract? It's not the insurance company, it's the government. And folks, the fact that the government is even remotely concerned with how much money you can put inside of a life insurance contract should tell you one thing as it relates to taxes. It's good. So what happens is you're able to put in money, and there's a lot of product designs that you can create. But in the 1980s, a lot of these original concepts were abused. So the government put in rules to make sure that people didn't put too much cash into these vehicles. And they created qualified plans. Now, you're probably familiar with qualified plans because these are sections of the IRS codes. And maybe you've heard of some of these IRS code numbers. 403Bs, SCPs, which stands for SEP or self-employment pensions, 401ks, which most people have at least heard of, and then IRAs, which stands for an individual retirement account. Those are qualified plans. And what that means is that you're able to take a tax deduction. You don't have to claim the income in the year that you put your money into these accounts, but you will postpone the taxation of that when you take it out. So what the government said is that if you try and put money into and up to this line at the top there, that all that money could go tax-free. But if you go over it, then it becomes a MEC, a modified endowment contract, or what we say is that you want to do up to, but not over, so that you have a maximum efficient contract, right? Now, so a lot of you, the minimum premium in this example might be $1,000. And then the max in this example, and it's based on age and health, but just again, this is just an example so you get the concept. The max in this example would be, say, $10,000. So if the cost of the insurance was $1,000, that means you have a place to put $9,000 each and every year and have it grow and compound tax favored in a tax favored environment. Now, quite often, most people look at this cheap premium, and that is also known as term. And term is what I equate to like renting an apartment, right? At the end of the time of your period of your rent, your lease, at the end of that, you get nothing back. It's the same thing with term. I think it's estimated that 99% of all term contracts never get paid a claim by the insurance industry. It's a huge racket. That's why when most times you go into a big city, some of the tallest buildings in the city are insurance companies. So, being able to take your mindset and say, hey, this is an expense, I get it, right? Because $1,000 is an expense. But we try and help people to understand how to create what we call an asset class. Where can we put and grow and compound without income restrictions, maximum amount of premium into a contract, and by the least amount of death benefit that an insurance company tells us we have to? So, that being said, let's talk about what the perfect investment might look like. If we could put money someplace, what kind of features would we want our investment to get? Well, I think in other videos, and I just alluded to it here, I think that a great feature or benefit of some type of investment vehicle or place where we can house our money should get tax deferred growth. How about once you put it in, you could take it out tax free? That sounds attractive. What about if we could get competitive returns? And in today's environment, I mean, that's what people are looking for. What if we could put in large sums of cash where we didn't have these restrictions typically imposed upon us by our 401ks, IRAs, or 403bs? What about additional benefits? Maybe disability or long-term care features? How about collateral opportunities? Being able to not have to put up your house or a building to be able to secure capital should you need so. What if we could create it so that it was just safe, right? So that it was just not in the market subject to market risk. How about no loss provision? So that extra $9,000 had a provision in there where it couldn't go backwards. Would that be attractive? How about guaranteed loan options? This is a little and often overlooked area. Having done this for almost 30 years, I can tell you we're in low interest rates environments, but we'll not always be here. Back in the late 70s, early 80s, some of you may remember back in the Jimmy Carter administration's interest rates being 14, 15, 17%, right? Well above double digit. Well, mortgage rates were 14, 15, 16, 17%. What were CD rates? Well, they were right about there too, right? 15%, 17%. So one advisor that had CDs from Tennessee at 21%. So if those times come again, what if you could get your hand on capital at a predetermined guaranteed borrowing rate, let's say 5%, right? Would that create opportunities? So guaranteed loan options at a predetermined borrowing rate is just, to me, it's just smart planning. Unstructured loan payments. So if you did borrow money, wouldn't it be beneficial to not have these rigid structured payments? So what quite often properly structured cash value life insurance can do for you is for you to determine when, how often, and even if you want to pay that money back. And this is really, I think, the crux of everything, right? We try and teach clients how to have liquidity. It's a key word there, having access to your money. Suppose the greatest investment came along right now and you were absolutely going to just make a killing, but you couldn't access capital. Well, how mad would you be? Having access to your money should you need it is why we promote liquidity, use, and control. You should learn how to always have access, liquidity, use, and control of your funds. Then deductible contributions. What if you could get all of these benefits and this was what we deem the perfect investment? Well, I can tell you that that does not exist. The perfect investment does not exist. So out of these benefits, what if you could get all of them except the deductible contribution? See, life insurance premiums, right, are not deductible, but that's how you get the money back to you tax-free. So, the living benefits, all these features, it is something, like I said, this is not an end-all be-all solution, but it should be part of your overall plan portfolio. And as I said earlier, create something called an asset class, cash value life insurance. And I will reinforce that by saying properly structured cash value life insurance is the single greatest gift that Congress has ever given the American taxpayer. So if you have an old policy, and I just had one the other day that I looked at, where the client had purchased this almost 6 or 8 years ago, and we called up together the existing insurance company and ordered something called an in-force policy illustration. When we got that, based on today's current crediting rates and economic environment, that policy was shown to lapse at age 91. These clients were really, really upset because it was not designed correctly. So if you have an old cash value life insurance, not everyone should be replaced, but it should definitely have a second opinion hat on it. And we're willing and able to do that for you at no cost to you. So if you'd like to understand better what you have, find out what your options are, we're going to invite you to reach out to us. Let's have a 5 or 10 minute phone call and see what we can do. Chris Lester, Chartered Financial Consultant, Retirement Income Certified Planner, Certified College Planner from Somerset, New Jersey. Just wishing you to have a great day and look forward to speaking with you. Bye-bye.